Welcome to Value Research Helpline once again. Last week we started this exercise, and we were just enamored with just too many questions. And I'm sorry I was not able to take most of it, but this time I have prepared myself little better in terms of listing the prominent question, the leading question which started pouring in, and we have picked up. First I'll start taking the set of questions which are reflective of, these are the kind of questions which many of you are asking at the same time. So I just might be listing one person's question, but many of you have similar questions or around the same question, and I would like to give you the rationale for my answer so that it is more useful to everybody with similar anxiety or questions or worry. So let me start without uh, any other description. Raghuvanshi Kadaboina is asking that I'm 36 years and I've already invested in FD, fixed deposits, post office schemes, PPF, EPF, NPS. My goals include a yearly holiday, a retirement plan, buying a new home in 3 years. Where should I start investing and how should a diversified portfolio look? You are 36 and you have already built all the foundational things for an investment. Foundational because your fixed deposit, post office, EPF, to a great extent, I would say, are dominantly fixed income. They are of highest safety available in this country, and it is good to have that. NPS is something which can be targeted to your retirement. You still have, you are 36, and I don't know if you retire at 58 or 60 or 62, depending on where you work or till when can you work. But NPS, if you don't touch it, and if you are investing 2 lakh rupees a year, it can well take care of your retirement plan. So you are left with all other goals, which is your annual holiday, and you are buying a new home in 3 years. Buying your new home in 3 years, you should, I can give you a framework. Of course, this is not a good program, a good engagement for me to get into a very specific advice, because it is a function of how much are you going to save, what is your income. But I would give you a guideline. When buying a home, you should have 3-4 things which you should check. One is that you should be buying a home which will start saving you the rent. So if you are living in a rented accommodation, a rented home, then a house, then you should think in terms of buying a home which will immediately, or in a defined period, should be able to help you save on the rental outflow. And when planning your house, you should have your down payment to an extent that EMI is not exceeding a third of your income. If these two things are in place, that you will get your house and you will start saving on your rent and it will not exceed a third of your income, then go ahead. Otherwise, wait till the time you have down payment enough so that these rules are complied with. That will make sure that you will have you'll not have, buying a home will not cause anxiety to you. Annual holiday, I think you should take it as it comes by. Just do your recurring deposit for the annual holiday, because this is you need every year, or maybe connect your bonus if you get some to this holiday, and be little flexible about it. I move to the next question. Shashi Bala is asking that my friend and I have invested 32 lakh and I have invested 32 lakh in ICICI Credit Fund and Kotak Credit Risk Fund. Please advise what should I do. I am in depression. Please guide me. First and foremost, Credit Risk Fund, the risk has come about. Though all these credit risk funds, they have not faced a default except for Kotak, which faced a crisis with the IL&FS. But except for that, they are not facing a crisis. They are not facing a credit crisis. But there is a crisis that most investors are so risk averse right now that they are running for cover. Everybody is queuing up. In fact, ICICI Credit Risk Fund is facing a redemption of nearly 25-30 crore a day. There was a time when on a single day it faced a large redemption in March. That was, and it has come down steadily from nearly 12,500 crore to 6,700 now. So investors are concerned understandably. Everybody thinks that anything which is double A or A is untouchable. There is absolutely no market. They are finding it very difficult to sell to meet the redemptions as and when. So, but so far, and these fund companies, because now it has been a while now, 3-4 weeks. So all these fund companies have prepared themselves with greater liquidity. They are investing more in gilts. They have sought a SEBI permission to increase their gilt allocation even in this credit risk fund. They are maintaining, and they have been able to honor, the massive outflows so far. And I'm hopeful that the kind of preparedness they have done, they should be able to. They are likely to face a liquidity crisis of immediate kind. Likewise, even Kotak Credit Risk Fund, there has been a decline in. It has been a decent performer if you look at 3-year return. But who is looking at 3 years when everybody is so worried that will they get their principal back? So many people are pulling their money out. We have bad news coming from all around. And this exodus itself is the biggest risk which mutual funds face, and they are facing it right now. Particularly about your question that I'm in depression, this is quite alarming. Any investment which forces you to get into depression, which depresses you, you should take that money out. Our investments, our money is supposed to help us do things better, find greater independence, not trap us. It should not be a cause of depression. So pull your money out because what is the payoff? We should be taking all our risks with equity, and we should be looking at fixed income in a more conservative way. It should definitely not cause anxiety, and depression that you're referring to is extreme anxiety. So I would say that even though the risk has come down or these fund companies have prepared themselves with greater liquidity, there might be higher return given that interest rates are coming down. But stop this. Stop your depression, take your money out, and you are not in losses. Why you should be depressed? Nirmal Singh is asking that how do I build the debt component of an overall portfolio? If one has already invested 3 lakh rupees in PPF, senior citizen scheme, what are other options should one consider? I would say that there are different scales. One is that you are the foundational part of your portfolio, a part of your portfolio which is absolutely risk-free. Many people have PPF, many people have fixed deposit. One can call it emergency fund. One can also call it, even a long-term portfolio which is meant for retirement. If it is 50% equity, 50% debt, for sake of simplicity. Even that should be, one should try and, if normally we say that normally value research has held this view that for your long-term investment, you should not be investing. You should not be doing your PPF, because PPF is a very long-term recurring deposit. It's a long-term SIP which yields fixed income. And when you are doing such long-term 15-year SIP in a fixed income, it is better to take your chances with equity, and equity turns out to be a superior performer over any 15-year time period. So, so despite all the upheavals that we have seen, equity ends up doing much better than what PPF will deliver. But once you have accumulated your money in PPF for historic reason, then I think one should hold on simply because the return from PPF is tax-free. It is absolutely safe, and every investor should have some fixed income. So if you have accidentally accumulated your money in PPF, then one should hold on. So I would say that if you have your PPF, if you have your senior citizens, these are the highest safety, the most safe instrument which investors can aspire for in India. They are virtually, they're sovereign guaranteed in a way, because you are putting your money in National Savings Organization with Government of India. So in that sense, the likelihood of default and reasonably high return, when I compare it with other fixed income alternatives, they are reasonably high. And given that, if you are actually, taking a long-term view, uh, the the safety coupled with a reasonably okay return or high return makes it worthwhile. But at the same time, you have limits here. You can't invest as much as you want to. Your total annual maximum investment in PPF cannot exceed 1.5 lakh rupees. The maximum investment in senior citizen scheme cannot exceed 15 lakh rupees. Uh, the senior citizen savings scheme gets you the return, which is also taxable. And for a long-term investor who is investing in fixed income and not derive and is not looking at deriving periodic return, uh, it is always good to defer your income in a manner that it can be, tax deferred. You don't have to pay taxes on the money which you earn, which you don't intend to consume. It is a cumulative thing. It is just meant to provide stability to your portfolio. So for those reasons, I would say that err on the side of caution. Last week I was telling you about getting into relatively safer fixed income alternatives, fixed income funds. The advantage is that when you invest in them till you need them, that money, all the accumulation is tax sheltered. Only when you take a part of that money, even only the gain component is liable for taxation, is treated as your income if it is less than 3 years, and over 3 years it is treated as long-term capital gains. So I would say that first build your PPF, senior citizen savings scheme, post office MIP, and after that venture into the liquid fund and the short-term bond fund. Last week I gave you the list. I would like to you to just focus on them. Uh, Deepak Ramaswamy is saying, in spite of RBI's effort to enhance liquidity, why aren't banks cooperating with loan borrower or individual customer? Uh, like you and me, they have also become risk averse. And even though RBI is increasing enhance the liquidity, but funds are happily putting the money in the reverse repo simply and earning 3.5%. They don't want to take chances. They are very unsure of, they will get their principal and interest on time and principal back, and they just might be more rigorous with their credit evaluation. So they have also become risk averse. They will be validating it. RBI enabling liquidity is no guarantee to liquidity getting passed on to the real consumer. So it has to, we really need to get back to normalcy in our surrounding. When businesses people start taking, going back to their work. Bankers are sure that people will get their salaries on time. Bankers are sure that their customers, the businesses they are lending to, their customers are buying their product, and they will get. So the cycle has to start. Until that apprehension remains, I think these are early days. Once we have the lockdown over and the normalcy is restored reasonably, I think the lending borrowing cycle will start again. Nellore Vittal is asking, what is your outlook on gilt funds and banking and PSU funds after the recent rate cuts by RBI? Kindly make a provision in Value Research Portfolio Tracker to include sovereign gold bonds. Okay, two completely different question, but one is that the gilt funds have been an accidental beneficiary of the crisis. RBI has gone about doing these successive rate cuts and taking us by surprise. Yesterday itself we had the rate cut, and so in that sense, and there is still room. There is still room for RBI to cut further because and RBI's view was very grim, that they see that for the first time our GDP will shrink, and in that sense, but that is RBI can do as much, and I think there is still 0.5% or 50 basis point room for RBI to cut rates. So in that sense, if you have been a gilt fund investor, you have been a beneficiary. Gilt fund is a very risky thing. Gilt funds, though not risky from the kind of risk that is visible right now, gilt funds are pretty safe that you will get your principal back. But at the same time, gilt funds can also be very volatile. When interest rates go down, then they appreciate. And because interest rates have been going down in a hurry and successive rate cuts, so they have appreciated substantially. In fact, looking at 1 year return, it looks quite unbelievable that we have returns ranging between 15 to 20% in gilt funds. But the best time to invest was a year ago. but still there is some headroom. But this will warrant that you not only you invest, but you also disinvest. You also sell your investment in gilt funds at the appropriate time, because gilt funds immediately reflect the interest rate outlook or interest rate changes. And these changes come about with a great surprise. We will also see, when the tide turns, when we see the normalcy, these rates are unlikely to stay this low for all times to come. But of course, that could be longer. The other side of the gilt fund is that once these rate cuts stabilize, once these rates stabilize at lower rates, then gilt funds will not appreciate. They will in fact earn lower return. So just be prepared for that. The result of these rate cuts, that they have appreciated, they can appreciate some more because there can be some more rate cuts. But after that, they will yield low return, and whenever it turns around, then they will actually lose in value as well. Many a times, gilt funds sometimes show a kind of decline, which sometimes look like equity decline. Your suggestion that Value Research Portfolio Tracker should include sovereign gold bonds, yes, we are just about to introduce that, and you will be able to choose whichever series that you bought. So far there has been about 15, 20, and they are all issued at different rates. They are at different prices of issuance. So you will be able to choose from the different series which one you bought, how much worth, and it will be able to reflect the market value, and also the terminal value as and when. So we will try and accommodate the two worth of these sovereign gold bonds for a unified tracking of all your investments. Bala Sairam is asking that, is this the right time to invest, or should I wait till September 2020? Which sectors will boom from 2020? I'm sorry, I don't have an answer to both your questions, and I have some suggestion for the first part of your question, that should you wait till September? No, ideally you should have invested on 27th of March, because that is the time when it was the lowest. But we got to know that lowest only once the time has gone by, and since then the market is up about 15-20%. So if you try and time it, it will be very difficult to invest. If the market goes up by another 10-15%, all the losses will be gone. So I don't know, and then it will become extremely difficult for you to invest. If you invest today, then the problem is that the market will go down further, and you will panic if the market falls further. So I would say that take a middle path. Take a middle path in terms of whatever money you have. We are in the month of May, so maybe spread your money over the next 8 months. You'll be catching some high, you'll be catching some low, maybe, and the market is very volatile. Few days it is high, few days it is low, and quite dramatically. 2-3% decline, and again has become a matter of routine. So I would say that do a weekly SIP. 8 months, 32 weeks, or 34 weeks, 36 weeks, divide your money with that, and do your weekly SIP. You will be somewhere in between, and it will save you from all the anxiety of when exactly to get in and which sectors will boom from 2020. I'm waiting for a very diverse boom, but yes, things are, there could, I have one suggestion, that when you invest in a mutual fund, you naturally get diversified, and that is the simplest way of doing it, because the fact is that we don't know. Some sectors will do well, some sectors will not do poorly, but there will be exceptions in all of them. There will be sectors in which there will be great companies, which will do well, and there will be sectors, disappointing sectors, in which there will be great companies which will do well, and there will be great sectors in which some companies will disappoint you. So sectors don't matter. How the fund manager is using his brilliance or selectivity or sector preferences, it'll all matter in a fairly combined way. So I would say that choose a good fund manager who has reflected wisdom, character, and diversity at all times, reflecting those processes. That will come in handy. So don't try to be very precise and maximize your return. Sagar Patel has asked the most important question, which many investors are asking, that I'm stuck in Franklin Ultra Short Term Bond Fund and some small cap fund. Please, please guide me how to get out of them. Franklin Templeton came up with an update this week that they have appointed an advisor to advise their trustees, and Kotak Mahindra Bank, the debt investment banking division, capital market debt group, something like that, has been commissioned for advising them to how best to get out of their, realize the money. So let's see the outcome of this. They are at it. They are keeping us posted. They have become extremely liberal with their disclosures. We know. So I think, in Franklin Ultra Short Term Bond Fund, I'm hoping that 15-20% of the money should come back to you in a month and a half. But let's see. We will keep you posted. I'm trying to create a story on the homepage of Value Research Online where we'll be keeping you posted about all the developments, all the small, big developments, as well as information on Franklin Templeton, these 6 funds, so that all the anxious investors, including us, are able to, keep track of things more closely. Nikhil Kapoor is asking that, is it a good time to invest in value fund? Please suggest a good value fund. Value fund have been a struggle for last 5 years. They have been a test of patience. And some of the very impressive value fund, they are actually, they have failed to perform. But now I find that, they look compelling value. So they will do well. I would say that, if you have been holding, I would anyway say that, an investor should have a diversification of style as well once your scale grows. So I would say that a third of your money should be in value fund. And if I have to recommend 1 or 2 value fund, I would say that the 2 funds which I like, one is the Tata PE ratio fund. It's very impressive. It's value, but yes, coupled with with a growth orientation. Likewise, L&T India Value Fund. So these are 2 of my choice from the best funds selection of Value Research. Prakash is asking that, what is your view on Nifty Bank? It has 38% weightage in Nifty and has most badly corrected. How do you see the outlook for this sector after RBI's announcement, and what is the outlook for Bajaj Finance, HDFC, etc.? I don't have much of a view on Bajaj Finance and HDFC, but I can share some interesting information that I too have been curious about it. I find HDFC Bank very impressive on all counts in terms of consistency, and in its life of 25 years, HDFC Bank has gone down by ranging between 40 to 50% on the stock market, only on 4 or 5 occasions, and right now it is down about 35%. So it might be, and all such crises that we have seen in the past, maybe the scale of HDFC is big, the uncertainty about HDFC, about the leadership changes is very significant. But at the same time, I would say that the scale of HDFC, the kind of culture that has been built around, I don't think those things change very dramatically. At the same time, India remains a growth market, and HDFC shows a very unusual flair for avoiding all the mistakes that bankers do in India. And first and foremost, it has the liberty to do that because it's simply not a government-owned bank. So government-owned banks have all kind of constraints, or they have to act. They are under no compulsion. Despite that, I would say that HDFC is a class apart. Bajaj Finance is a different story. All that we think of Bajaj Finance, that it's a consumer lender. Yes, it is, substantially, 48% only. 52% is not consumer lending. It is a very usual kind of NBFC which is facing all the standard kind of struggles. So ignore that. And 38% weightage in Nifty. Yes, I'm reminded of, there was a time in 2002 when the weightage of technology companies in the Sensex and Nifty was 48%. So it is not etched in stone. The weightage of index actually changes if the stock prices collapses, or some of these weightages, or something else grows much substantially that their weights come down. And we could have those kind of rebalancing or say realignments happening. And I'm expecting that much sooner. So I would say that this 38%, my view is banking is a great sector, but not all banks. There are great banks. You know, if you look at the 10-year, go to Value Research Online, click on the banking index. You look at the 10-year return of the banking stocks there. Look at the max and the minimum. Just do the sorting based on 10-year return and 5-year return. You will know what I mean. So all banks are not the same. Selectivity matters, and be selective. Jitendra Brahmecha is asking that fresh subscription stopped in debt funds by mutual fund. How will it impact existing SIP, SWP, STP as well as withdrawal? If you are referring to Franklin funds, they are stuck. You have to worry, and you will be able to do only when a part of your money comes back. But there are other funds, there are other debt funds which have stopped taking money, but that has not prevented you from taking your money out. And if the fund has not prevented you from taking your money out, then your SIP, SWP, and STP will continue. You don't have to worry about that. So funds have only stopped taking new money into their funds. You should not worry about any of these. So I'm done with the most prominent 10 questions, which is reflective of 30 other questions which people have. People had similar questions. Now I'll move on to this very rapidly moving screen in front of me, which is Balaji V is saying that audio and video out of sync. Balaji, I'm new at it. I don't know what to do about it. We'll try and fix it. I'll have a chat with the person who are helping me do it live. I'm doing it from my study. Please tell a good banking fund. Banking funds. You just go and do a selection based on the numbers. The numbers are not very different. Now let me move to. The screen is moving so rapidly that I'm finding it difficult to read the questions. So I'll just go at the bottom of it. Devinder Pal Singh is asking that should we SIP or lump sum for NPS considering that the time horizon is long? I would say that any market linked investment you should always consider being a regular investor. Regular investor for two reasons primarily. One is that it fits in with our income cycle. We earn every month. Why not invest every month? And then when you are investing every month, your anxiety is in check. So why you should accumulate your money somewhere and then go about investing one day, making it a big event, and then causing a great anxiety for yourselves. So be a regular investor. What is my take? Ishwar Galani is asking, what is your take on DSP small cap fund? I like this fund. This was a erstwhile micro cap fund. It was a blockbuster, but this is a fund. In fact, I'm answering most other people, which is not you, that don't get tempted by small cap fund. These funds are not meant for everybody. These funds are meant for somebody who is willing to assume risk, who are willing to invest regularly and see their money decline for a prolonged period of time in hope of getting rewarded after 4, 5, 6, 7 years. And that is when it becomes extremely rewarding. So if you don't have that stomach, if you don't have that heart, don't even think about it. So most investors can do without investing in a small cap fund. But among the small cap fund, DSP small cap fund is an impressive small cap fund with a long history. Is it good time for Balanced Advantage Fund? For all first-time investors, Balanced Advantage Fund it's always a good time to start investing in Balanced Advantage Fund. Think of it like an equity fund. Think of it like an equity fund for conservative investors who will have a big problem when they see the market upheavals. A Balanced Advantage Fund will actually have the shock absorbers built in, so that it is like introducing somebody into helping you start swimming. So you just you are at the edges and trying to figure out things. It helps you get used to the market. So balanced advantage funds are a great way for investors to start, and so you should start with them. When are you starting the mutual fund analysis service? Very soon. We are actually in the phase of testing internally, and we are not only testing it, we are doing a very rigorous testing and also making some changes. We find that it's going to be the first of its kind, so we don't have a benchmark. We are virtually inventing this service. So we are not only launching this service, we are also working on version 2 of this service. So you will have this service coming to you soon, maybe in few weeks time, and then in few months time, 1 or 2 more months time, we are working on the next version. So we are using this lockdown as a great opportunity to focus on those things which will have a very lasting bearing in terms of providing a useful service to all of you. And the inspiration for all this service enhancement, or the packaging, or the way we have articulated or designed this service is we are trying to do this service in a manner that all the questions that you are asking, you should not have to ask them. You should be able to answer all these questions yourself. So the component, of course, I understand that there will be a need for many a times. I know that you are not coming to me for answers. You are coming to me for second opinion. You are coming to me for reaffirmation. You have taken a step and you want it to be reaffirmed. So maybe we will still be relevant for that. But I would say that we are designing the service in a manner that most of the routine questions, and if you are confident about yourself, you will not seek reaffirmation. In extreme times, yes, we all seek reaffirmations, but that service is good. And I'm using the service in a manner that all the things that I have to do for myself, all the things that I have to do for my parents' money, all the things that I have to do for my children's money, or my uncle's money, the people who are at different stage of life, I try to anticipate their question, or I listen to their question, and I try to devise a solution in that service. So I'm confident that that service will actually change the way you look at things, and it will become your friend for all times to come, and a neutral friend. Now I'm just getting too many questions. In fact, I'm working hard. I'm just putting the mouse at a point so that I can hold the screen. And for SWP monthly income, okay. I will have a suggestion that will make my life a little easier. Don't go and type parts of your question time and again, because I'm unable to make sense of it. For example, I just got that for SWP monthly income to get the index taxation benefit, can you suggest funds? I think the first part of this question is somewhere else. Deepak Trivedi is asking that, sir, you must start something like PMS. No, we don't have any such plans to launch a PMS. PMS is, supposed to do many other things, including, please, customers, look at the inefficiency of pre-PMS, tax inefficiency. When you invest in a mutual fund, the mutual fund acts on your behalf. One, mutual funds are very tightly regulated. PMSs are lightly regulated. You should have a minimum cutoff. You should have a minimum amount of 50 lakh rupees to invest in a PMS. Then the expenses of PMS could be very different. And look at the tax inefficiency. The PMS, buys and sells, securities on your behalf, and all the short-term capital gains are taxed as short-term capital gains, long-term capital gains differently. In case of mutual fund, if you invest in a mutual fund, whatever the fund manager does, buys something every day, sells something every day, till you hold a mutual fund for 1 year, it becomes, your equity fund becomes, lower tax, eligible for lower taxation, 10% flat. So in that sense, tax efficiency, tight regulation, intense regulation, and high disclosure standard, I think that actually makes a much stronger case for mutual fund. And our premium service, I would say that, when it comes to any financial service, cost itself is a feature, and the lower the cost, better it is. And if you feel, and it's always otherwise when it comes to, and if you are able to think little methodically, it's not rocket science. You can achieve 90% of it with great simplicity. And why not do it yourself with far greater confidence, and the joy of learning things to do and to be in control will be another bonus. Rajesh Alim is asking, hello sir, I'm doing consolidation of 6 funds into 2 multi-cap funds from December 2018. Is it the right time to continue consolidating the funds? Yes, it might be okay. It depends on which 2 funds are you consolidating your money into. If they turn out to be, if they have good long-term track record, they have done well in a rising market, done relatively well in a falling market as well, and both the fund managers are still there and they have more than 5-year track record, by all means go ahead. Aditya B is asking that any suggested specific fund to increase emergency fund corpus. Your emergency corpus should be invested in liquid funds, period, at most. Emergency fund can have multiple tiers. A small part of your emergency fund should be lying in your locker if you have young children. And now everybody should have some money in the locker ever since this lockdown happened. So that's the first stage. Then some money should be there in your bank account, which should be accessible from an ATM. Then you should have a credit card on which some credit should be available. So that is also an emergency fund, though it is not your money. But that's the only credit card withdrawal mechanism which I suggest is justifiable, not for consumption, but definitely not for credit for consumption, but a credit for emergency just in case you have exhausted these 2 options. And beyond that, the money should be in liquid fund. It should be earning less. Maximizing return on your emergency fund is not the primary goal. Your primary goal is that the money must be there, no questions asked, and it should be accessible in your bank, and they are accessible in your bank at a 12-hour notice and up to 50,000 rupees, sometimes instantaneously. So that should be the hierarchy, that should be the scheme of emergency fund. Pratyanshu Mahapatra is asking that I want to invest 20,000 rupees monthly income from now. My age is 55. I have around 30 lakh rupees. Please suggest me. Pratyanshu Mahapatra, I'm assuming that you are planning your retirement, you have 30 lakh rupees and you have 20,000 rupees more. 20,000 rupees more is 2.5 lakh to 2.4 lakh rupees a year. And if you are retiring at 60, then you still have 5 years to go. So that will be something like 12.5 lakh rupees of principal to be contributed, 30 lakh rupees that you already have. I would say that this 30 lakh rupees is a very important money. You shouldn't be taking chances with this, but at the same time, not taking chances will make sure that you don't have enough of retirement corpus from which you can withdraw, and your goal should be to have so much money that if you start 6 to 8% withdrawal from all your accumulation at retirement, then that money should last for a lifetime. That money should not be consumed while you're still alive, which means that you will have to do some estimation in terms of how much income you require in your retirement and target that money. And with that in mind, and if you have never invested in a mutual fund, if you have never invested in anything which is linked to the market, then I would say that start with a balanced advantage fund. And this 30 lakh rupees, if it is lying in fixed deposit or something which is in your bank account or something, I don't know which form it is. If it is invested in market linked investment, then fine, by all means let it be there. Don't take your money out. This 20,000 rupees, if you are a first time investor, invest in a balanced advantage fund. If you have been investing and you are used to the ups and downs, then start investing in a multi-cap fund, 1 or 2 multi-cap fund. And this 30 lakh rupees, if it is in fixed income or in your bank account, then spread this money over the next 30 months. Or maybe 36 months, over the next 3 years, every month investing in some such fund, a balanced advantage or a multi-cap fund, simply because you need to really optimize and maximize your return while you still have 5 years to go. And maybe balanced advantage might be the most appropriate thing, relatively more conservative vehicle, as you just have 5 years. And after that, you don't need all the money at one go. you need to mount a SWP of 6 to 7%, depending on how much income you require from your investments, and then be at it. I'm sure that a market-linked investment for your retirement might be necessary to make sure that it is able to not only beat inflation, to able to support inflation beating income requirement. Abhishek Kavlekar is asking that if redemptions are high, can equity mutual fund also shut like Franklin debt? If redemptions are high, equity and debt are little different. The debt market got frozen. Equity market, there is always a market, howsoever low. We saw that in the year 2008, the small cap funds went down in value by 70%, 75%. But there was a market, there was a willing buyer at a certain price, at a very low price. So you lose your money, but there is a market. So there hasn't been a situation that a lot of investors in the equity fund has been shut down. But yes, if in the back end, if the stock exchange is shut down, then equity funds will also shut down, because mutual fund is nothing but a vehicle to reach to access that equity market. I will just take a small pause for a long monologue which I have been doing. Shaja Aziz is asking that is it a right time of portfolio rebalancing? Yeah, absolutely. If you haven't done it, I think the best time to do your portfolio rebalancing would have been 31st March, because that is when equity values tanked so much that if you would have decided to have an asset allocation of 50% into equity and 50% into debt, then debt went up and equity went down. Equity went down by 20, 25%, 30%, or in some small cap and mid cap combination went down even further. So in that situation, that is the time you should have a rule of rebalancing, and Value Research Portfolio Tracker will help you do that. Maybe very soon you will have a feature at Value Research that you can set up alerts on your asset allocation. If you have chosen your asset allocation to be at 50-50, and because of your investment in all kind of investments, whether it be stocks, debt mutual fund, equity mutual fund, balanced fund, or investments in debt directly, or NPS, if you have chosen and somehow you have achieved an asset allocation of 50-50. If your 50% equity becomes 40% equity and debt becomes 60, you will get an alert. So, and you can set the alert depending on at what percentage change you want to be alerted. So you should act when, ideally, normally you should have a time frame that every year you should do your rebalancing, or you should have a rider that if you have, if your allocation changes by 10%, you will act. So if your 50% changes to 55 and 45, then also you should act. Then after that, a further fall, again it becomes 55, 45, you will further act. So the virtue, this will be a very methodical way of buying high, selling low, with some discipline. And Value Research Online Portfolio Tracker, the enhanced feature, will help you do that. Is it Badri Narayan is asking that your review and comments about Permanent Portfolio by Harry Brown, please. I don't know what you're referring to, Badri. Tuskala, I can't really figure out the name, but can VR advisory service suggest stock for SIP? We already have a service called Value Research Stock Advisor. It is used by over 10,000 investors. It is not a very old service. It is just over, it was launched in October 2018, and it has not even completed 3 years. Here we actually take a very long-term view on stocks, and we suggest those stocks. So far we have recommended about 38, 39 stocks. And of these 38, 39 stocks, we make recently we started something which is over and above this, that of those 38, 39 stocks, we have filtered about 14 of them, which are best buys now. That best buys is actually a subset of all our recommendations so far. All our recommendations are kind of stocks which should be bought and held for many, many years. And when it comes to investing in stock, one should always spread one's investment. If I tell you that, here is my list of 15 best buys in Value Research Stock Advisor, I suggest that you invest in all those stocks little bit every month, or some of them every month, another lot every month, maybe 5 stock every month, maybe next 3 months keep repeating it. I'm not very sure of our perfection in timing of the buy price, but we are very confident about the kind of companies we are recommending, the companies which will withstand the test of time. We do a very rigorous fundamental check on those companies. We are normally tilted, and this is a single service. It is not a large cap, mid cap, small cap service. It is not a growth service, or it is not a value service. It is all in one service. There are small companies. There are very large companies as well. There are companies which we like because they are growing very rapidly, or they have the potential to grow very rapidly. There are companies which we like simply because they are reasonable companies. They are not growing very rapidly, and they are completely out of favor. They are so attractive that the downside is very low, and someday the market will recognize. So it's a combination of all those things. Though I would say that our value orientation is little limited. Those selections are much smaller, but it's a simple service, and those stocks you should be buying it regularly. And so we have a service, Value Research Stock, and go to Value Research Stocks. You will get the key features of this service. And if you have some more questions, do ask. We have a customer service person who is always there to answer you if you have any question. As per SEBI order to list wound up schemes on exchanges, yes, this is the most important thing that has happened, and I'm hopeful. Let me give you a perspective on this. This is a question from Deepak Kumar. What will be the should we opt for this exit route or wait for the AMC proposed 5-year exit plan? I would say that AMC, when it comes to communicating officially, it has given you a very official statement that there is a 5-year exit plan. AMC would like to get rid of, get this problem out of their back as fast as possible. And I don't think the debt crisis will linger for 5 years. The problem that we see right now is that the market for lower rated bonds is frozen, and this is unlikely to continue for 5 years. So as and when the market becomes alive, they will be able to sell it. At the same time, interest rates have come down. Some of these high yielding bonds might fetch a decent price as well, as and when the markets are not frozen. The risk aversion will not continue forever. Maybe it can continue for long, but it may not continue forever. And definitely forever meaning definitely not 5 years. So I would say that when it comes to officially communicating to you, because fund companies are liable for all kind of legal, they would like to err on the side of caution. So they are suggesting 5 years. The new development that has come about is that SEBI has permitted funds to list these schemes. Rightly so. They are closed-end funds right now, by their very design. And if you need money urgently, and I'm hopeful that there will be a market for them. Most closed-end funds do not trade. There isn't an active market. But these funds have a large investor base and a large asset base. If they are listed, there will be investors who will be willing to buy these units from the market at a discount to their NAV. And if for a part of your money which you need desperately, you should realize that. But look at the price. Everything has a price. You have to look at the kind of discount that it will trade on. Is it worth it, or can you really wait? Because this is also a very unusual structure. Most closed-end funds they have a defined term. This is a closed-end fund which does not have a defined term. By its very design, a small part of your money will periodically keep coming back to you. So this is a shrinking closed-end fund. So it is very difficult to understand the pricing or the discount, because when I actually do a discounting of a closed-end fund, assuming that there is a fund which is trading at 20% discount to its NAV. I know that if I take it at a 20% discount to NAV, 3 years from now I will get this much money plus some potential gain on the underlying. In this case, I don't know, because what part of my money will come back to me from the fund company? I'm little unsure. And the fund will be desperately working towards, it has already appointed an advisor to help it sell the underlying securities. What part of my money will come back to me without any discount? So the valuation and the discount will be complex, but I think it is a good step. It will provide, desperate investors who need a part of it, particularly in the ultra short-term bond fund, because that's the kind of fund which investors park fairly routine short-term money in such funds. They will have at least an alternative avenue. I'm getting some questions which I'm unable to make out. What minimum max return in large, mid, small cap after 20-25 years? Okay. Prakash Pandey is asking that what is the maximum minimum return we should expect in large, what is the range of return which we should expect in large, mid and small cap after 20-25 years? Oh, you are making me feel like an astrologer, but 20-25 years, I don't know, but I can give you some way to think about it. One is that, last 25 years, the kind of returns that we have seen, don't expect that. Because last 25 years, of those 25 years, 15 years we had, I don't know if how many people will recall that Government of India tax-free bond used to yield 11%. 11% tax-free return in a country where interest rate was regulated. So when you have risk-free return of 11%, equities gave you, a very unusual return. 18, 20, 25% return was quite a decent, that was the equity risk premium that you expected. We have all heard of Warren Buffett, the investor who is very successful because he made a lot of return, and of last 10 years he is struggling, or he is unable to, recent few days back I was looking at his return. He was unable to match the return of gold over the last 20 years. But that apart, a celebrity investor, and his return has been 10%. But his return is 10% and looks good simply because the inflation and the interest rates in US is 1 and 2%. If we are going to have very low returns, low inflation, low interest rates, then 10-12% return could be very high return. So these are all moving targets. They are not frozen in time. It is not that I have to magically tell you that, okay, 20% return is what I expect. Yes, good for me if I'm able to derive that. But 20% return, if inflation is 12%, will be a very poor return. And 10% return, if inflation is 1% and fixed income return is 4%, might be a very decent return. So it's all a function of the environment and the context. So think about it holistically. And if we have inflation of that kind, then you will have home prices which will be lower, home loans which will be available lower. So the incremental cost, because high inflation leading to high interest actually creates the real return on your investment is what matters. And if you adjust all your returns for the inflation, that is what is material, and you should keep that in mind. Any plans for mobile app for VRO? Sarath Pravalika is asking. Yes, our mobile app is almost ready, and that's also undergoing a testing. So you'll have many things coming, but this is something on which we started very late. I have not been very convinced of, first we wanted to have a mobile friendly website, and mobile friendly website, the app will not have any significant advantage except for some speed and loyalty in terms of once you have downloaded it, then it will become simpler for you to access things. You don't have to go to a browser, but in terms of experience, 80% of it will be about the same. So, and now our website is quite mobile friendly. All the pages are designed customized for the mobile usage. So I think your experience in a limited way will be of reasonable kind. And yes, Value Research mobile app is coming. Shankar Raman is asking that you perhaps missed your opinion. On banking and PSU fund. Please enlighten us. Banking and PSU fund, was it in the context of the of equity or debt. There are banking and PSU debt funds, and there are banking funds, and there are PSU equity funds. When it comes to equity, I hate banking funds which is dominated by PSUs. I also hate PSU equity funds simply because government is a very bad owner, and we have seen value destruction of an unusual kind. Great businesses being managed in such a manner with the kind of short-termism or whatever, there is something in the air which actually makes it. And whenever the public sector is exposed to competition, we find them to be in great difficulty. Look at the MTNL, look at the Air India, the Indian Airlines, and many such examples. So whenever a company is exposed to domestic competition of an intense kind, and which most interesting areas of business eventually become very intensely competitive, they are unable to combat on the ground in the marketplace. And in a monopolistic situation, yes, these companies look very nice, very handsome, doing very well, but they don't have a benchmark. But the moment they are exposed to that, and we have seen that kind of long-term value destruction happens in PSU, in government-owned companies. But the same is not true for the debt funds. Government being these companies being dominantly government-owned, or being perceived as financially strong, or not honorable companies which will not default on their creditworthiness, creditworthy companies. So in that sense, debt funds becomes a very attractive thing from PSUs. So debt, PSUs and banks, where you have seen it all the time, that whenever there is a panic, people rush to State Bank to make deposits, and we see and we know where those people are coming from. When it comes to buying such stocks, we have seen the value destruction. If you look at the two aggregates, CPSE ETS and Bharat 22, they have been an unmitigated disaster. One can say that they look extremely valuable, they look very cheap, but they were cheap and they became cheaper. And when they will turn around, I don't know. They should. There is so much of embedded value in them. Their dividend yield is very high. They always look attractive, but they looked attractive even 2 years ago, and they have, investors have lost very meaningful sum of money there. Arunab Singh is asking, should I switch my investment in SBI Focus to SBI Dynamic Bond Fund? SBI Focused Equity to SBI Dynamic Bond Fund. Why should you do this? When you invest in equity, you are investing your money for a few years, at least 5 years, and you are doing your SIP. And when you are investing in a bond fund, you are normally not wanting to take a great chance with your money, and you want little superior return than what is available in the deposits and liquid fund. So I would say that both funds are of a different kind. If you are doing it to do a rebalancing of your portfolio, that's a different story. Then by all means you should do it. But moving lock stock from equity fund to a bond fund because of the context, no, one should never do that. Tanishk Monga is asking, AMCs. Tanish Monga is asking that AMCs are transferring their lower rated bonds from credit risk fund to hybrid funds. Your views on this? Yes, they would have done to an extent, but hybrid funds, the balance fund, they always had corporate debt as their by their very design, because these are long-term investments and fixed income is supposed to provide a stability. Their equity portfolio is reasonably liquid, and historically they have been investing in corporate debt to enhance their return, also in predictable return, because these are high yielding bonds, and these funds are also unlikely to face the crisis. So one important thing which you should understand is that the crisis in the bond funds and the bond market is that we still don't have the credit issues. But we have a huge risk aversion which has led to drying of the market. Everybody thinks that A and AA is untouchable. No, they are worthwhile assets. Just that today the weather has changed completely. So in that sense, and many of these companies, they are able to get, in fact, most of these funds, I was talking to some of them, and many of these funds are able to realize a part of their prepayment, they are getting their interest on time. A good part of their money, they are requesting the companies that, okay, if they have liquidity, they would like to redeem, they would like to surrender those bonds. So many of those companies are actually able to, uh, able to buy back their bonds themselves directly from the fund companies. So it is not something, yes, it might look like a opportunistic thing to do, but historically hybrid funds have done that. But yes, there are funds which might be doing something inappropriately, valuing it incorrectly. That is something which SEBI will take care of it, and they have been at it. I know of many instances where SEBI has been able to spot them in a fairly timely manner. Taking this last question, which any invest with majority when it becomes a major. So it should be as much into equity. When you have year before his graduation money into a fixed income fund. When he's in second year, have graduation started. That is the child plan for you. Don't look for a predictable return, because the moment you are guaranteed of X amount of money to be put in for these many months or these many years, and you are guaranteed this much, that number might look big, but the return in annualized terms, in percentage terms, will not be big, because there is always a cost of that guarantee. Don't fall for that. So thank you very much. Sorry once again for the number of questions that is just coming by. It is rolling so rapidly, and I'm unable to answer so many of them. But I'll be looking at these questions, and I'll try and write 1 or 2 columns, because many of these questions I would like to deal with it in a manner that you have the principles in place. If you have the principles in place to decide on your own, that will be a great thing. Besides that, all the tools that we can provide at Value Research Online, which will help you do things yourself. So if you know the principles, and if you have the tools to apply those principles, that will come in handy. So thank you very much for being with me. I will come back to you once again next